Well, I want to talk about materiality and risk assessment. So Maria, I'll start with you, but I want to hear from each of the auditors because materiality, it's actually one of the risk assessment standards. So it's part of risk assessment. It's one of the most important judgments an auditor makes in designing and planning the audit. Talk a little bit about how materiality impacts risk assessment in general.
Sure. So, materiality, starting point, and we know it by the standard, is a quantitative measure. And so you start looking at a quantitative measure, usually around pre-tax. And what you're trying to, remember we said risk of material misstatement. Well, what's material? So we're still anchored in the materiality standard, quantitative. Then you go to qualitative. That's also part of the standard. And from a qualitative perspective, a risk qualitatively could become a higher risk, right? Or a lower risk, depending on all the factors that we've talked about. So I would say that materiality comes into play when you think about the quantitative and qualitative aspects of the type of risk that you're looking at. Others?
I would say that when it comes to assessing materiality, it's generally easier to think about it when you're looking at the financial statements as a whole. But going back to what Phillip was saying with respect to the complications introduced in a group audit, it becomes very challenging then when you're looking at a group audit that has business units all around the world. And you have to also, in addition to assessing materiality for the consolidated financial statements, but the tolerable misstatement that you're setting for each individual component where you're going to be gathering audit evidence. Because that affects, in particular, an error that might arise in one location that might not be material, but if that same error is arising in multiple locations, it can aggregate to a material error. And so you have to know how low to go, while balancing, how efficient you have to be as an auditor to make sure that you're addressing that aggregation risk of errors adding up together to be material. And you have to think about each individual location's quantitative and qualitative characteristics that might lead you to lower the tolerable misstatement for that location.
I agree completely with the description we've made so far. Materiality, I think, as we described quite rightly, is one of the most difficult, nuanced judgments one has. So the quantitative piece works well when the company's making regular profits and they're behaving beautifully and the benchmarks all work out swimmingly. It works well when it's a single entity. As soon as these complications come in, we drift into a world where auditors have to make judgments with limited quantitative science behind them. Limited research on how do you actually assign a dollar metric in a group audit, or in a loss-making company where you no longer have net profit to look at. How do you go about making those assessments?
One other thing that can be complicated when assessing materiality is we establish that early on in the year because we need to use that materiality measurement to scope our audit on which locations we're going to, which accounts we have to address, and so forth. And so that figure is often based on a projection that management has, whether it be revenue or profit. And so we have to not only assess what that appropriate materiality number is, but whether we can rely on that projection. And so that also involves, assessing management's effectiveness of setting projections and how accurate they've been in the past. Because what we don't want to run into is, down the road when they're missing projections, having to lower our materiality and then start our risk assessment over again and potentially expand the audit work we've done to date late in the audit.
Well, I think we can all certainly agree that materiality is incredibly important, and the FASB has shown us that it's also difficult to figure out how to address it from an accounting perspective.
I think the one thing, too, going back to management, I go back to Mark on this, but at the end of the day, we have this expectation gap outside stakeholders in terms of what they believe an auditor does, right, in terms of our reasonable assurance on the financial statements taken as a whole. But as auditors, we do have to make sure that the audit committee and the management team understands what Elizabeth just said happens, depending on what happens in their own business, to how we plan and go about the risk assessment and all these other things. So the knock-on effects, right, because we have to reevaluate our materiality, like the risk assessment, throughout the course of the audit.